And, in the late 90s, even early 2000s, the West Coast, was all about picking the right stocks, that sort of stuff. It's the GFC that put me on the map. All of a sudden, markets became very macro influenced. Most strategists did not have a macro based approach.
Today's guest is François Trahan, one of the most respected macro strategists in the financial industry. He was one of the few warning about the 2008 financial crisis before it actually happened.
I happened to have the right call, which helped. The bulk of it centered around the fact that the last stretch of the tech bubble had been fueled by circumstances outside the US. And what I mean by that is the Asian crisis, the Russian default that triggers LTCM, forces the Fed to inject liquidity into the US economy. I feel like what's missing in education, it's psychology, the influence of behavior. At the end of the day, the one commonality between every asset bubble is human beings.
If you want to hear insights from a macro strategist without the fluff, you are in the right place. This is The Blonde Dollar with Ignacio Ramirez. Quick disclaimer, the views and opinions expressed in this podcast are those of the speakers and do not constitute financial investment or legal advice. This content is for informational and educational purposes only and should not be relied upon as a substitute for professional advice. Always do your own research and consult a qualified advisor before making any financial decisions. All investments involve risk, including the potential loss of capital. And now, let's get started with the episode. Hello everyone and welcome to a new episode of the show. Today's guest is François Trahan, one of the most respected macro strategists in the financial industry. If you follow markets, you've probably heard his name before. He's a Hall of Fame ranked Wall Street strategist, former head of macro research at firms like Bernstein, BCA Research and Wolfe Research. And now, more recently, he was the founder of the Macro Research Institute, which is a study program that prepares investors to invest in all types of macro backdrops. François has been named Institution Investors #1 strategist multiple times. We'll be talking about that. And unlike a lot of macro strategists out there that just talk theory, he actually gets markets right. He's a real practitioner. He was one of the few warning about the 2008 financial crisis before it actually happened. And his 2011 book, The Era of Uncertainty, pretty much nailed how markets would become way more volatile in the years ahead. In this conversation, we will deep dive into his career journey, his biggest calls and mistakes, and his blunt take on why smart people still get markets wrong. If you want to hear insights from a macro strategist without the fluff, you are in the right place. François, welcome to The Blonde Dollar.
Thank you. Thank you for having me.
Super excited to have you here today. Of course, a lot of the conversation today is going to turn around macroeconomics and strategy. But before we dig into that, can you drop us a line or two on what is it that you're actually doing today in the Macro Research Institute?
So we basically designed a study program, not unlike other certifications, CFA, CMT, that sort of stuff, that is built around applied macro for financial markets. And so it's a 2-level program. It's hosted on the Canvas platform. People can do it at their own pace. That's called the macro specialist designation.
Is it all online or in person? How does it work?
It's all online. It's all it's all online. We do, I host a monthly Q&A session for the candidates that are in the program. But other than that, it's all pre-recorded videos. It took years to make, I'm not going to lie. Some of them are now done with an avatar of myself. That makes my job a little easier. But it's all online, designed to be completed at someone's own pace. And so you're not locked into take an exam on a specific date. You can set it aside for a month for, any reason and just pick it up after.
Pretty big step from going from working in Wall Street banks to teaching. What what pushed you in that direction more recently?
That's not easy to answer. Well, you have to, for the first part of my career, I've been publishing macro research for 30 years almost. For the first almost half of my career, I was kind of a unicorn, on Wall Street because most strategists did not have a macro-based approach. And, in the late 90s, even early 2000s, there's places where I couldn't go. You couldn't go meet clients. Clients wanted nothing to do with me. The West Coast, was all about picking the right stocks, that sort of stuff. And so I feel like it's the GFC that, put me on the map because all of a sudden markets became very macro influenced. I happened to have the right call, which helped. And as you pointed out, I wrote a book in the wake of that was talking not just about more volatile markets ahead, but also how we would usher in a completely new era where growth, would essentially be the asset class to own. There's a lot of mistakes in that book as well, but we got the main thing correct. To answer your question, in November 2016, so every year I would have this ritual with my team around Thanksgiving in the U.S. where we would try to think about what can we do differently next year? What can we try? To not to reinvent ourselves, but to just stay fresh. And, when you're in the role of a portfolio strategist, you tend to have a lot of interaction with CIOs, directors of research, portfolio managers. And I covered, that field very well. We wanted to reach the younger generation. And so I put together in 2017 a string of, one-day macro seminars. I forgot the exact title, but it was, very lengthy. Introductory principles of macro for financial markets, something like that. I did not know if anybody would show up, so I rented a big room in New York, and I think 143 people showed up, which surprised me.
Pretty good.
Yeah.
Yeah.
I want to say half the audience were faces I recognized, but the other half were clearly younger and people that I did not know. And so, that was New York in January, and then I did Toronto, Chicago, San Francisco, Boston, and the last one was London. So I did one a month in the first half of the year. And that's basically what made me realize that, there was a tremendous amount of appetite for macro education. So I want to say that it's around then that I started thinking about this project, but it's not until the pandemic took hold that I decided to, dive headfirst into it.
To give it a shot.
Yeah.
And you never look back. It's pretty rewarding, I can imagine, no?
Oh, yeah, it's fantastic. I want to say it's probably the most rewarding thing I've done in my career, the most fulfilling thing I've done in my career.
Nice. I think we're going to go back to that, to your the teaching part of your career, but I want to start from the beginning. Many questions already. You alluded a few seconds ago to a call that you made that proved to be right and that put you a bit in the radar, because obviously every very successful person in finance, at least on the strategy side, tends to have this big moment, a trade, a call, a report that put them on the map. And I wanted to ask you, what was the first time your market call really made waves? What was it?
Well, the first time my call was correct, or the first time that it made waves?
The first one correct. The one that was correct.
Oh, I think so I'm on a very small platform. This is like May of 2000. And, I've been in New York for a few years, and I wrote a report. It was something like sell semiconductors, buy home builders, or something like that. So it wasn't a great title, but the message in it was that tech was vulnerable. I don't think it made waves, Ignacio, because again, I didn't have a big footprint in the industry. But when I think of the things I got right for the right reasons, sometimes they get lucky also. There would be that call.
And which date was that?
So that's May of 2000. I think I still have a printed copy of it somewhere.
So pretty good timing before the 2001 whole .com
Yeah.
explosion.
Yeah. I had already been, writing about how, tech was going to end, but because I remember very contentious meetings back then, and I'm a lot younger, I'm not established. And so, it was harder to have credibility with, particularly with very well seasoned investors at the time. Um, but officially, I put the flag in the ground, and it was May-ish of 2000 or thereabouts.
And what was it that raised red flags for you? What was the canary in the coal mine kind of thing where you were like, okay, something is wrong here?
Yeah. So I would say the bulk of my thesis back then with a couple things, but the bulk of it centered around the fact that the last stretch of the tech bubble had been fueled by circumstances outside the U.S. And what I mean by that is the Asian crisis, the Russian default that triggers LTCM, forces the Fed to inject liquidity into the U.S. economy at a time where the economy was doing great, and that's what created this blow off in the bubble. And the Fed reverses that in short order, and so we went from having all the juice that came from these emergency rate cuts to all of a sudden we were taking back liquidity. And so it was merely focused on, the Fed is now tightening policy. At some point, it takes a while. The lead lags are always hard to explain to people, but at some point they will start to slow growth. And, tech stocks of the day were not immune to that. There was a tremendous amount of risk taking. And that's the first thing that starts to change at the margin, when the Fed starts raising rates.
Wow, very interesting. I want to touch upon now the opposite question, because you were asking like the best or the worst call.
Yeah.
What was one of the worst
The
market
worst
calls
calls.
that you've ever made? And
There's
how did you bounce back from that?
Yeah. Well, there's a lot of them. So so I just talked about a great call with regards to timing. Fast forward a year to 2001, and leading indicators recovered very briefly, and tech stocks are down dramatically by then. And I interpreted that as a pro-cyclical message that would revive. I don't want to call it the tech bubble, but would revive tech stocks, and so that ended up being pretty dreadful. So I looked phenomenal, and kind of blew it a year later by completely misunderstanding what was happening.
So the paradox of Francois and tech stocks in 2000 and 2001, they brought you into the spotlight and they took you down again.
Yeah.
Wow. Okay, so I want to go back to the beginning now. I mean, you grew up surrounded by numbers. Your dad had a PhD in math, and your mom was an accountant. You were probably doing yield calculations in your head before most kids would even know how to divide. And what's interesting is that despite being, I think, a quant, or at least someone that really likes numbers at heart, you've said that you later realized numbers alone don't always tell the full story. There's behavioral finance, there's history, there's psychology that ended up maybe playing a bigger role in how you see markets today. So my question for you is, looking back, what's the one thing you wish you had studied earlier in your career that would have made you an even better macro strategist?
Yeah, that's a really good question. So for the record, I was not a great student. I was exceptional at one thing, which was math, and I was pretty lousy at everything else. And I didn't appreciate that. I think sometimes just they say like the children of lawyers end up making better lawyers than others, and so I didn't appreciate how my background, even unconsciously played a role in all this. I also, went to school at a place that had a very empirical approach. We did a lot of econometrics, that sort of stuff. So the answer to me is pretty simple. I feel like what's missing in education, macro is a big part of what's missing in how we train people, but it's psychology and the influence of behavior. At the end of the day, the one commonality between every asset bubble back to tulips in Holland in the 1630s is human beings. They're the ones that are making these decisions. And we seem to repeat, these patterns time and time again. And so psychology would have been a big thing. And then history is the other. I think that one I could, I wasn't knowledgeable enough in school to understand how important history is. But to me, those are the two big things that, that I would tell someone currently in school to try to take something related to behavioral finance, even if it's not called that. And, history of economics and financial markets is really, really important.
Yeah, I think at least when I was in school, there was nothing close to behavioral finance, but history for sure. And unfortunately, when you're in school, at least in my case, it wasn't the most sexy of topics. But when you work in finance and in markets, indeed, you have this tendency to realize that history doesn't repeat itself, as they say, but it has this tendency to rhyme, right? So I wanna go back to when you were named as Institutional Investors #1 strategist. It has happened multiple times, and you even got inducted into their famous Hall of Fame. For those of you that don't know it, Institutional Investor is a leading international business-to-business publisher, very well known. They focus primarily on international finance, and they cover markets very, very well. So it's a must read for many of us working in the industry. So my question for you is, what do you think separated you from the thousands of other analysts and strategists that never made it into that famous Hall of Fame?
Well, it's a lot of things, including a lot of hard work, but including luck, I think at the end of the day. So, uh, I get to New York, I think in 98 or thereabouts. And I'm working on a small platform. In 2002, I joined Bear Stearns, which I think was like the fifth biggest bank at the time, but it was kind of the hot one for a while. And, that's when I started to appreciate the importance of, the II rankings. And I realized very quickly that anybody that was ranked II, I don't want to say could get away with things, but, they had a different status than me. And anybody who was ranked II #1, was basically the golden child of the place.
Superstar
And
status.
yeah, and, I think the industry back in those days viewed it as a good proxy for investor interest. I think back then it was. And so, they had a dedicated team that would help you understand II. I understood nothing of it. Um, and where you needed to, after a few years, what they would do is they would say, okay, you did really well in the Northeast, here's where, you're not getting any traction. And what they would hope you would do is spend more time in that territory in the following year. So it helped me understand a lot of things. So I think to rank II, you first have to take it seriously. But it's very difficult to rank II if you're not adding value for clients at the end of the day. And remember, in those years, one of the few people, working for a big bank at least, that has a top-down approach, that is doing macro work. And what that had forced me to do was spend a lot of time writing about sector positioning. So my bread and butter in those years is always about which sector to emphasize, which sector to de-emphasize. I've never been a guy that makes big market calls, Ignacio, to be perfectly honest. I got away with years without even having an S&P target somehow. But the bulk of my work was, identifying risks, obviously, but how to position your portfolio for them. And so, as much as I want to say it's the fact that I was kind of the only person competing doing macro, I think it was really the fact that I was doing something that was super helpful for portfolio managers by writing week in and week out about sector dynamics and how the macro backdrop would feed into that.
Yeah.
And I think my first year, I ranked sixth in 2002, which, there's maybe 20 some people, that are participating in the survey. And I remember Bear Stearns being very happy with six at
Yeah,
first.
it's pretty good already.
Yeah, I think I had matched their best result in portfolio strategy there and then. And then I think the following year I got to rank number two and then eventually number one.
It's funny because hearing you talk and how you try to understand their methodology on top of obviously they're delivering value to your clients, of course, made me a little bit think about the algos in social media, because I didn't mention this at the beginning, but Francois also is very active on social media. He has a huge following across different platforms. So did you kind of adopt the same approach to become big in the finance social media world, or it just happened a bit randomly?
No. um, well, but that's a good point that you raised, right? I basically, with regards to institutional investor, I had to first understand the mechanics behind it. And I realized very quickly that if you're at a small platform, your odds of ranking in the II survey are minuscule because you just don't have enough potential accounts, that can vote for you. And so it is skewed towards, the very big banks at the end of the day. So with social media, Ignacio, I'm not even on Facebook. And so, my team coaxed me for a long time to get on. And I think I got on LinkedIn about 4 years ago, reluctantly, I want to say, at first. And I kind of viewed it as a bit of a running blog for my clients, if you will. So a lot of the stuff that I put on there is something that didn't make it into one of our reports, for one reason or another. We publish a 10, 11, 12-page report every week. We probably have 3 times the material that we can fit in there. And so that's the stuff that I end up putting online. I do other things, but I would say mainly that was the impetus behind it. I viewed it as a, running blog for my clients. Obviously a lot of other people, like the content, but I wasn't trying to be a big, social media influencer or anything like that. It was really targeted. I don't want to say by accident, but a little bit, that I ended up, getting a pretty healthy following.
Plus, I mean, you already had a huge following and great reputation in real life, so that obviously helps a lot. But yeah, if you are not following Francois on social media, please check it out. Check him on LinkedIn, for example, because he has great and very insightful posts. I want to go back before we get to the whole Bear Stearns era to your upbringing, because you are Canadian, right?
Yeah.
So you didn't come from an Ivy League school. You studied at University of Montreal, and you built a name for yourself. And this was back then when finance was even more cliquish than it is today. You said in the past that talking very good English helped, but obviously speaking English is not enough to make it into the II Hall of Fame, for example. So what was the single thing, if you had to pinpoint one thing from your upbringing that helped you get into the inner circle of Wall Street superstar strategists, apart from the hard work that you alluded to before?
Well, I wouldn't downplay knowing how to speak English, because, my generation back home was not bilingual. There was, a few kids that, spoke English, but it's different now, I think, with social media and the internet. But back then, it wasn't obvious. And I remember, in fact, I go to the introductory meeting. This is in the economics department at the University of Montreal, so for my undergrad. And the head of the department, so there's like 300 people in the room, and the head of the department says, if you don't, very bluntly, if you don't speak English, get out. I was like, oh, and his whole thing was English is the language of science. Every book we will use here, even though this is a French-speaking university, is going to be in English. And so if you don't have a command of the English language, go do that and then come back because you will struggle immensely. So I do think, being perfectly bilingual, my mother moved to the U.S. when I was very young. And so I spent my summers there. I learned English. I was 8 years old in one summer, just playing with the kids in the neighborhood. So I don't have much of an accent, and so I think that definitely helped. You told me to not talk about hard work, but I particularly when I got to New York, I realized that I didn't come from a big family, or I didn't have the network of someone that came from an Ivy League school. So I did feel like, the one way I could compete was by working harder than anyone else. And for a while, that became my mantra. I would try to find who is the one person that everybody thinks is the hardest worker, and that's the person that I would always try to outwork, if you will. So in those early years, that's the feature that I think makes me stand out a bit. But there's a lot of luck, involved. I don't want to diminish ranking II and all that stuff, but at the end of the day, Bear Stearns was a big moment for me because, they hired people like me that didn't have, necessarily the Ivy League pedigree. And at a time when other firms didn't do that. And so when I think about my career and what gave me, a big footprint very quickly, that was a seminal moment for me.
So, okay, now we gotta talk about Bernstein's. So let's rewind to the early 2000s. So you're working there, and very interestingly, you left before the financial crisis hit. So you've joked in the past that this wasn't some type of Nostradamus move, that it was
No.
just lucky timing. But given that you were one of the few strategists raising alarm bells on the housing market,
Yeah.
was there ever a moment when you were there where you thought, maybe I should get out before this whole thing starts shaking? Hey there, quick favor to ask. If you enjoy the blunt dollar, the unfiltered takes, the stories, and the laughs, the easiest way to support the show is by tapping that subscribe button right now while you're listening. And here's my promise. If you do, I'll keep bringing you honest conversations, fresh perspectives, and the kind of finance talk that's engaging, insightful, and worth your time. Thanks so much for being here, and let's keep these great finance conversations going.
No. So this is where the expression "better lucky than smart" comes in. So I get to Bear Stearns in 2002, and again, I'm a little naive about how Wall Street works, and I don't understand how II works and all that stuff. But for me, it was a big break, and Bear in those days had a terrible reputation as a place to work at. For me, it was fantastic. But, to the outside world, it was viewed as being sometimes, very competitive internally with sharp elbows. I didn't have that experience. I absolutely thought it was the best job in the world. So that starts to change. In 2006, excuse me, I publish a report on the housing bubble and how it's going to end. And that did not make me very popular with my colleagues and and upper management. at the time. But you have to remember that in the post-tech bubble era, there's now a lot of lawyers, that work with management at all the big banks. And once you submit a report into the system, they can't pull it. And so you're the only person that can pull it. And at the end of each report, it says, these are, my thoughts, not influenced, blah, 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 blah. And so it was, I submitted to editing. It was a long process when you publish at a big bank. And I get pulled aside, and just asked, are you sure you want to publish that? Do you not understand where you work at and how we make money? And so, to their credit, the report gets published. And clients weren't happy either, I want to say at the time, because, it's never popular to tell people you've made a ton of money. It's been great. Here's why things are going to change. I think that changed my relationship with management a bit, to be perfectly honest. What saved me, Ignacio, is that unbeknownst to me, there was a team that I think was in the Philadelphia office of Bear Stearns, and they were called something like the new products team. And so they would take reports of different analysts and they would turn them into some sort of financial instrument. They would take the theme from it. And unbeknownst to me, somebody took my report and they created a note that allowed you, to bet against housing, and, raise a ton of money overnight in it. So,
And you didn't know about it. It
no,
just happened on the background.
didn't know at all.
Wow.
All I know is that I'm getting a lot of, dirty looks, and all of a sudden, I have this box delivered to my office, and it was this mug that I have it right up there, as a matter of fact, that says, Mr. Housing Bubble, if I pop, you're screwed. And in the back of the mug are the details of the note. So they were using this as a marketing tool, sending it to different clients. And so that's when I find out about this.
Oh my God.
Yeah. And that's what put me back into the good graces of management a little bit, because, Trahan's generating money, but I think deep down it had still caused a little bit of tension. Now, I didn't leave Bear Stearns because of any of that, or because I had some great insight as to what was going to happen. I understood housing was a bubble. It's not like I knew, Bear Stearns would disappear. I didn't understand that part at all. So, it's kind of weird sometimes how circumstances pan out. But in September of 2006, I'm at work and I'm doing a conference call, and I have like 800 clients on the line, and I have this excruciating pain in my lower abdomen. I'm on a conference call. Nobody can see me. I'm not on video. But I knew something was wrong. My appendix basically ruptured. So fortunately, it's like minute 55. And so, ended the call a bit abruptly. And you did ask how this happened. I ended up in surgery very quickly. And because I had my appendix ruptured, I had to have the full surgery, not just laparoscopic stuff where you're back home the same day and back at work very quickly. I had like the full scar and a drain in for a couple days. So I wasn't able to travel. And, in those days, I'm on the road every week. And so now all of a sudden, I'm landlocked in New York. I can get to work, but I have to take a car. But there's no way I can go on a marketing trip, visit clients. And so I'm just, at the office, and I get a call from someone at ISI that says, Ed Hyman would love to meet you. Would you be able to come in for a cup of coffee? And under normal circumstances, my travel schedule would have made that, 4 months later, and so all of a sudden I have nothing to do. I'm like, yeah, I can come today.
Let's
And
do it.
so that was my introduction to Ed Hyman at ISI, and this is probably early October 2006, something like that. I had many other meetings with them, and you know, um, that's ultimately what leads me to leave Bear Stearns. But again, I didn't have any great insight. Everybody thought I was a little crazy. Like I shared it with my family, and they were like, "Wait a minute, you're the chief strategist at Bear Stearns, and you're going to go work for who? A little shop that has 100 employees." But you have to remember, in what I did, in the field of macro, that was the place.
Yeah.
So my departure was more about that than anything else. I was very lucky.
Basically, I mean, it's funny because I haven't counted the amount of times you mentioned the word luck in this conversation, but it appears
Yeah,
quite regularly. So my question for you is, how much of a strategy success is about seeing things early, and how much is it just about being at the right place at the right time and having a little bit of luck?
yeah. Well, I think if you're not adding value for clients, you're not gonna have success. And so that's number one. But there is luck involved at the end of the day, not necessarily luck in terms of your market calls, but sometimes it's life circumstances. As I was mentioning, if I'd never had, I keep thinking back, I turned right when I should have turned right. I turned left when I should have turned left. If I'd never had appendicitis, I don't think I ever would have ended up at ISI. Which for me set the ground for other things in my career. And I would say, I consider Ed Hyman to have been one of my mentors. And so that's what I mean by luck. It's not so much, you know, looking like you're lucky with your market call as much as it was life circumstances at times that made some things possible.
Okay. Wow, that's interesting. Yeah, I guess like it's a mix of a mix of circumstances. At the end of the day, luck always comes to those that work the hardest for some reason. And yeah, it looks like you had both. You said that you were working harder than the hardest working person in the room, and all those great
Yeah.
things happened to you afterwards. So it doesn't surprise me.
Yeah. And yeah, in those years, that was definitely my mantra. Um,
So now I'd like to ask you a little bit more about macro as a strategy, as a profession, the how it was back then versus how it is now, and your career specifically. So in 2011, you co-wrote this book, The Era of Uncertainty, saying that the days of smooth, predictable cycles were over, and that we were entering a period of booms and busts. And a lot of the time, a lot of the people at the time dismissed it, but now it looks pretty spot on. So my question for you is, what's the biggest misconception people still have about macro and how it works today versus how it was in the pre-2008 world?
yeah. Well, before the GFC, so in the pre-2008 world, we are at the tail end of the Great Moderation, which is a period that spans the early 80s to basically up to the GFC, that was a phenomenal period overall for the stock market, but it was, largely attributable to macro events. It was a weird confluence of events that, made it possible, um, that basically restrained inflation continuously. And so I'm going to use the word luck again, but the U.S. was very lucky in that time frame because we have just-in-time inventory systems that are starting to be applied more broadly, and so that brings down inflation, raises profits. Um, the end of the Cold War saw all the former Soviet republics dump commodities on a global scale, weighed down on inflation. And the free trade agreements that are put in place, the first one in 86 with Israel, the second one with Canada in 89 that becomes NAFTA with Mexico, they start to also be disinflationary, deflationary, if you will. And so it was a confluence of a lot of things. What the book was about was talking about how some of these things, were no longer in place. And, so it was really, the era of uncertainty is what I dubbed what lied ahead. But what I was describing was a world that was no longer the great moderation. And, where in an integrated world, other people's problems could become our own. Like the debt crisis in Europe, Spain, Portugal, Cyprus, and then Greece finally in 2015. Um, you know, Peak investment in China around the same time frame weighs on commodity prices. Um, you know, all the while we have zero rates in the U.S. And so we don't have some sort of barometer that can influence the economy back and forth. So it did give us a lot of these little boom busts cycle. But ultimately, what I was describing, was a world where, steady Eddie assets would win the race. And, growth is the best compromise between cyclicals and defensives. And so it ushered in this phenomenal period for growth stocks. Um, you know, when you have uncertainty or a lack of visibility as to what lies ahead, you're going to have more. You're going to be less willing to, own something that has tremendous operating leverage, like cyclical companies, and you're going to want something that has some sort of structural story, and that's where the growth stocks are at the end of the day. I would argue that we're still in the era of uncertainty. It has evolved, and I think we're in a world that is now in the U.S. structurally inflationary. And so, for me, what the pandemic really taught us is that even in the 2010s, there are things that are changing beneath the surface. So demographic trends in the U.S. are slowing, not having an impact then, but caught up to us in the pandemic when, there were just no available workers. And we're in a similar place today that I believe is structural. And so, the world of the great moderation where inflation did this for almost 30 years, it would go up periodically here and there, but it was never a problem. It was an issue at times. I think is the world that's behind us, and we're going to be dealing with bouts of inflation, periodically, I suspect, in the future.
It's interesting what you were mentioning about the end of this period of the great moderation. It made me think about this book I read whilst I was at uni from Friedman. The world is flat, I think it was called, which basically the underlying premise I think was similar to what you just said, that other countries and other people's problems all of a sudden also become your problems because the world is a lot more connected than it used to be. And I guess there's some parallels between that and what you wrote in your book.
Yeah, and even for portfolio managers in the U.S., if you're benchmarked to an index like the S&P 500, a third of your revenues are generated elsewhere. And so when we say the world is connected, I don't believe you can have a view of the U.S. stock market without understanding what is happening globally. And that was a painful lesson for me, Ignacio. And you asking me what are some of your worst calls? It's times where, we do get a decoupling of sorts between the U.S. economy and the rest of the world. That never used to happen. And it happened a couple times in the 2010s, for instance. And I would argue even in the pandemic recovery. And that's just because all of a sudden stimulus and tightening was no longer in sync between central banks. We start to taper in the U.S. under Bernanke. Europe is dealing with the after effects of the GFC debt. And so they're stimulating like crazy. That's an unusual phenomenon. We haven't seen that often in the modern era. And it created a lot of funky relationships within the markets.
So talking about trends and global trends, I think we cannot have a conversation without alluding to AI. So you've built your career on macro research, and obviously you've also acknowledged some of its limitations. But now in this world of AI driven quant models and factor investing and so on, some people are arguing that maybe macro calls don't matter as much as they used to, maybe during all those years when you became so famous. So my question for you is, do you think macro strategy is becoming less relevant in today's markets, or is it still the key driver that everyone should be looking at? Hey there, quick ad break. Do you work in the finance industry and have a genuinely interesting story to share? I'm always on the hunt for great guests who bring raw, unfiltered insights to the table. Or maybe you know someone with a story worth telling? Please put us in touch. You can reach out to me directly via LinkedIn. I'd love to hear from you. And now, back to the show.
Yeah, I think it's more relevant than it's ever been in my career. And a big part of that has to do with our industry itself. Back in the 1960s, where a lot of the academic curriculum that is used today was developed, the average holding period for stocks is 8 years. And so if you're going to hold a stock for 8 years, whether the economy is going into a slowdown or recovery, not going to matter a whole lot, because odds are you're going to get a few cycles in there. The quality of management, that will matter. Potential acquisitions over 8 years, that will matter.
Mhm.
And so, that was a world where fundamental research was absolutely critical. I would argue it still is. But when I think of what has magnified the impact of macro, it's the fact that the average holding period for stocks now is down to about 6 months. And so if you're going to hold something for 6 months, so you buy a defensive because it has a great fundamental story, but you're buying it at a time when leading indicators are about to take off, not going to work out really well. Or vice versa, you buy a cyclical company, at a time when, the economy is about to slow,
Mhm.
you're ignoring the macro, not going to work super well. Or you're buying growth stocks in January 2022, that are very sensitive to interest rates, just as the Fed is about to raise rates aggressively. So I think it's the shorter holding periods that have magnified the influence of macro. It doesn't mean that fundamental research doesn't matter. It absolutely does, particularly in a recovery, where stock correlations come down. That's where stock picking, and I would argue that, to me, that's a pretty good description of 2025, in my opinion. But I think macro matters more than it has. Some people point to relationships that broke down in the pandemic recovery. You can find that in every cycle at the end of the day. And so it's not macro that didn't work. It's that you always have to put this stuff, in context. And we just went through the most unusual, period in the last, basically since the 1970s, if you will. And so context, was absolutely critical. So with regards to AI, I would say that I'm a believer in AI overall. I don't know that it makes a huge difference cyclically, you know, for the next year, but I absolutely believe in it. Um, I'm not a believer that it will take over macro and financial markets, because at the end of the day, it's using the inputs that are available, and there's so many misleading, things out there when it comes to macro. I would argue LinkedIn has a lot to offer in regards as well. And I've also seen in my career, I've also seen quant, and so let's think of it as a proxy for AI, come in and out of favor. In a trending market, everybody thinks they're super smart because they're using momentum, to pick stocks. and they'll tell you they have this sophisticated quant model. We have this algo, where momentum is like 80% of the story. And then leadership changes, and all of that era fades. And that's happened, I want to say, like every 5 years or so. And some have been, I remember January of 2016, where leading indicators turn the corner and all the stuff that had worked great, craters.
Yeah.
And that's the issue with momentum, is that when it fails, it tends to fail spectacularly. And that tends to happen when there's a change in leadership in the market. Excuse me. And so macro is going to play a huge role in that, in determining the influence of, on even which factors work. And so I'm not a believer that, the human component is going away in financial markets, because the best model wouldn't know how to handle something like 9/11 or, the pandemic in 2020.
The black swans.
Yeah. And the reality is they're not supposed to happen often, but there's been an awful lot of them in my career.
Yeah. So yeah, because it's funny what you're saying, because a lot of people think that macro strategy is just about crunching numbers, but at the end of the day, it's a lot about those things you were talking about at the beginning: behavioral finance, history, understanding the bigger picture, connecting the dots, spotting things that maybe models have missed, and yeah, yeah. At the end of the day, I think there's some stuff that an AI model might not be able to replace, which is human intuition. So yeah, it's a hard question that I like to ask my guests.
Yeah.
But like basically, in your view, then does macro research get better with AI, or is there something about human judgment that machines will never be able to replace, and basically this is as
Yeah.
good as it gets?
I think it's a little bit of both. Where I think AI will help is that it will help get a broad understanding of the main drivers of, the business cycle, which I would tell you is, the biggest one is monetary policy. That will get you 80% of the story. Then you have to put it in context. Fiscal stimulus inside can alter the trajectory of the economy at times. And so I think if the only thing that AI does is that it gets that broad, knowledge to be accepted, then people don't have to spend so much time on that mystery, or what is perceived to be a mystery, and they can focus on other things. And so I think that would put, the limits of what we can do with macro. There's so many interesting questions that are not answered. And I don't think it's AI that's going to answer them. It's humans doing the research, because it requires sometimes historical context. It requires sometimes behavioral finance. But if we have more time to focus on that, then I think we are advancing macro.
Good. So you're an optimist by nature.
Well, people have the perception that it's the opposite. But that's because when you're in my role and you do macro, I kind of view my role as I'm trying to highlight risks and opportunities that people don't necessarily appreciate. And because equity investors tend to be a glass half full crowd, more often than not, I'm pointing to risks rather than opportunities, if you will. So, when you were asking me, what is your best call? What is your worst call? My best calls are bullish calls. Nobody remembers them because, they feel like they only need a macro person when, the economy is not doing well and there's a lot of risks. The minute that things start to take off, my readership goes like this. And so, March of 2009 is a phenomenal call for me. 2 weeks off from the stock market low after nailing the bear market, and so I look great. Nobody remembers that part, and the pandemic, it was not an easy period, but I remember doing a piece of research where I was trying to see, what are the events that investors have been confronted with in the last century that they had never experienced before. And I was trying to find corollaries for, what was happening with COVID-19. And the best example, so I covered other pandemics, a bunch of different things, but the best example was 9/11, where the markets were shut down. We didn't have an understanding of everything. The government came in, pumped an insane amount of money, and the market went right back up. And so with hindsight, to me, that ended up being a great call. The government dumped an insane amount of money. The economy started to reopen gradually, initially. And the market did what it does when it gets stimulus. Money supply exploded, leading indicators recovered, and the market bounced back. So I tend to be remembered for the bearish calls, and I've messed up, a bunch of those too. But at the end of the day, you know, it's risks and opportunities. But when you do macro, you're going to be associated with the risk part more than the opportunity part.
I get that. So you've talked a lot about events, like you've seen the dot-com bust, you've seen the GFC, the COVID crash, inflation spikes, you've seen Fed pivots, and obviously as a strategist, you build this reputation of making sense out of all these chaos. But sometimes you know it better than anyone else. Markets play by rules that don't make a lot of sense.
Yep.
And sometimes macro models don't work, correlations break, and it's hard to interpret what's going on. So out of all the market cycles you've experienced, which one was the absolute hardest to make sense of, and what did you learn of it?
Yeah. That's a really difficult question. I want to say that for me, there were four that I would list as, being, I don't want to say non-traditional, but complicated. And some I got right, some I didn't. Would say the tech bubble, I didn't have the knowledge back then that I have now. And I think I would have handled that differently. I got part of it right. I got, part of it wrong. But even back then, I could acknowledge that this wasn't, normal stuff. The GFC, even though, I look brilliant, and to me, that's the highlight of my career. It's being bearish at the right time, being bullish at the right time. But it's not like I understood every moving part of it along the way. I understood the high level stuff. When the markets, completely froze, there's no precedent for something like that. That's where human judgment has to come in. I think the end of the investment boom in China, the commodity super cycle and what came in the wake of that was hard to understand. And at the end of the day, when I think back upon it, it's history that had all the answers and behavioral finance. Because what China did was, unprecedented. We'd never seen an economy grow investments to be 48% of GDP. And if you look back 100 years and you try to find countries that grew investments to 40% or higher, there's like a dozen at most. All of them end up in a crisis once you hit peak investments, or basically once excess capacity starts to set in. It's the beginning of the end, if you will. All of these countries end up doing the same thing because their domestic economy is impaired. They rely on the rest of the world, to save them. And what I mean by that is that their currencies devalued massively and they relied on trade or exports, to basically buy themselves time to absorb all this excess capacity. That was the best blueprint. China did it a little differently. Because what they did is they, did one fiscal stimulus after another. Some of it is just to shore up, banks and provinces, but they've accumulated a ton of debt. And, now they're left with less options than I would argue they had 10 years ago. So that was a complicated one, but the answers were there. If you were able to avoid the pressures of everyone else around you, you might remember how 10 years ago, how dominant, the China theme is. And then, obviously the pandemic was, also an unprecedented event. There were answers, but it doesn't mean that, there wasn't a tremendous amount of uncertainty regardless. There's things that we just didn't know. And at the end of the day, when I think of how the markets and the economy turned out in the pandemic, it had a lot to do with trends that were already in place. We just weren't recognizing them. But in the 2010s, most of the baby boomers start to retire. They were an unusually large cohort. And so, there are less available workers as the decade progresses. And the stimulus and the pandemic, created a surge in demand, the economy being closed, pent up demand, et cetera, at a time when the supply of labor is not what it's been historically. And so that had a lot to do with the boom in inflation. Everybody was obsessed with supply chain issues in 2021, which were a real thing. They are in every cycle, I would say, but usually when the economy recovers, that stuff goes away. It was obviously to a greater degree, but it's the dynamic that was happening in labor markets that ultimately proved to be the problem for inflation. And so that was a tricky one to understand.
Something came to mind while I was hearing you talk. How many times in your career, Francois, have you heard the words, "this time is different"?
Every cycle. And, and I think that's just a normal human reflex. I forgot when I did this, Ignacio, but there's one time where I went back and looked at every cycle post-World War II, and I was always trying to identify what is it at the time that investors could have looked at that would have made them believe things were different. And the reality is you come up with a list, for every cycle. And so I don't think what I've experienced in my career, is unusual in that regards. People believe that the recovery, will last forever because, the tech bubble, because housing, and people the China investment cycle. So I think that's a normal human reflex. And the way it is usually expressed to me is, Fed tightening won't matter because it's different this time. And that works in reverse. Fed easing won't help because it's different this time. That's the big story in 2009, is that the Fed stimulus, won't work. And, people had become insanely bearish at the time. And it turned out to be a pretty normal cycle. Leading indicators perked up pretty much on cue with their historical relationship. And so people believe that at times because of circumstances. To me, that's just part of the experience. There's always something that's going to be unique. And macro is not a crystal ball. It's a tool. It doesn't help you understand the markets, to the day, I would say, but it tends to help you set the trends. And every cycle, I feel like, demonstrates that, if you will.
Yeah. And always reflecting on things afterwards, it's easier, right? Because of this hindsight bias and behavioral finance, as we were saying. When you reflect on things that happened in the past, you're always like, oh, but there was this sign and this and that. But obviously, it's always different when you're living things at the present instead of analyzing it in the past. One last question regarding macro as a profession in today's financial environment. which is related to passive investing. So as we know, passive investing has exploded. Now ETFs and index funds control a big part of the market, and a lot of the money, people argue, is just blindly flowing into certain asset classes without people actually analyzing valuations and fundamentals and things like that. So my questions for you is, does macro investing still work the same way in a world dominated by passive flows, or are traditional signals getting drowned out?
Well, I would argue that now, you have a lot more investment tools, that you can use as a macro practitioner. And so for me, that's not a bad thing. When I hear you ask that question, one thing that I think about, um, it's not the only force that helped amplify passive investing, because that's, been a trend in place for a long time. But coming out of the GFC, we come out from having lived in a value world for 100 years to all of a sudden living in a growth world. And, you know, we're still dealing with that, I would argue. In a value world, you become skeptical of anything that's got a lofty valuation. In a growth world, it's a very different story.
Mhm.
And so, what you see coming out of the GFC is that the percentage of money managers underperforming their benchmark in the US explodes higher. And in the 2010s, it stays in that range. Writing that book in 2011 was partially, I want to say inspired by that, but I knew that, you know, my clients weren't doing well overall. I did a survey of my client base around that time, and I asked them, is managing money easier, the same, or harder than it used to be? And I think like 90% said harder.
Mhm.
And it was because people weren't really trained, to invest in a world that was now dominated by growth. And so, that's what I mean by it's macro events that change the backdrop. And, we're educating people for the value world to this day. I mean, now people have obviously, become accustomed to growth stocks doing well. But, the books that are used in financial education are still largely value oriented. And they would have kept you out of, the tech sector, basically for the last 15 years.
Wow, good one. I love that one. Um, so maybe for this last part of the conversation, couple of questions related to career lessons, maybe for those younger listeners that
Yep.
are thinking about breaking into the industry. You mentioned before that you weren't a straight A student, but yet you had one of the most respected careers in finance, from the ones I've heard, at least on the market strategies front. You've shared also anecdotes in the past that you once offered to help students find jobs if they sent you handwritten thank you notes, and only 2 out of 50, I think, did, and you ended up hiring them. Um, so you're obviously very experienced when it comes to talking to young people. And my question is, what's the one piece of advice that you'd give to young people today trying to break into the finance industry that they want to hear in career workshops?
Yeah. It's interesting. I didn't know that you knew that stat. So the story behind that, and that will help answer your question. I have a lot of former clients, that retired and are now in the world of academia.
Mhm.
And one thing they like to do for their students is take them to New York, for 3 days. We'll go visit the stock exchange. We'll try to meet, with people in the industry. And so I've been asked countless times, can you meet with my students? We'll be in town on this day. And I think the students walk in expecting me to give them a handout and to talk about, portfolio strategy. But I usually give the audience the choice. We can do that, or I can tell you how to find a job because you're all graduating soon. and usually that's what the conversation, turns to. So the anecdote is, one of the things that I tell people is that if you send me an email, I get hundreds of emails each day. Even if I have good intentions, I will not get to your email, because I have to deal with my clients and other things. And so what I would say in those meetings is, if you send me a handwritten thank you note, I will help you find a job. And then one time it was actually students from two different universities that were in our office. There's probably close to 50 people in the room. And that's the time that I only got like two.
Wow.
And I think I ended up working with both eventually. Um, so one of those that sent me a thank you note, kept in touch. And so this is a meeting that takes place like March-ish. I get a phone call, which is the other thing I tell people to do: pick up the phone. Nobody calls anymore. And she tells me, I'm in New York for the training program at this bank. Can I stop in for 20 minutes? I just have a few questions. And so I'm like, absolutely. I'm genuine when I say, I'll help you. And she came in with her questions really well prepared. That was it. Went to do her internship, kept in touch every 3 months or so, something like that. And a year later, I have an open position for an associate. And so, I said, would this be of interest? And, we ended up working together for 10 years. I have another person that currently works for me that came from one of those meetings as well. So staying in touch, building a network is, to me, the really valuable lesson. When I mentioned earlier, I think the thing that American universities do really well is that they do give you a network of alumni. I didn't have that coming to the U.S. I don't think I could have found a single person, from the University of Montreal back then. Now there's a lot of them. Yeah. And so building a network and maintaining them. So what I would tell these students is, everybody you met this week, you should send a thank you note to, and do your best to stay in touch, because this might be 5 years from now the person that will give you your dream job. Mm-hmm. You need to nurture your network. Mm-hmm. And that's not, in the days of social media, I would argue it's easier than ever. But I think it's not innate to human beings to do that. And so,
yeah, I was gonna say it's easier and harder than ever. I'd argue, because it's easier than ever to meet people, but precisely because you meet so many people, to nurture those relationships and to keep in touch also becomes harder and harder, I guess. So that's why also there's more value in nurturing those relationships. But definitely good advice, but not easy.
true.
One last question for you. You've worked with some of the smartest people in the industry: economists, fund managers, top strategists, but even the best can overcomplicate things and miss the forest for the trees sometimes. So my question is, what's the one mistake that you've seen even the smartest people in finance keep making over and over again?
Well, it's different this time is one. And sometimes, it ends up being true. And so, but I feel like most of the times when that doesn't punish you, you're just end up being right, even though you didn't understand everything that was happening. I would say that's a big one. Um, you know, I've always tried to place an emphasis on applied concepts. And so I don't care what the theory says if it doesn't work in real life. For me, that's not super helpful. So I've seen a lot of people that are anchored to, theoretical concepts, which is most of what you learn in academia at the end of the day. It's a painful lesson, um, it's a painful lesson when you're giving advice on financial instruments. And so, I will not own that stock because it's too expensive. um, was the way to live up until the GFC. That's been very, very painful since. Being too rooted in theory, and history is littered with, LTCM, littered with academics that try to give it a go, and it doesn't work. And so that's the things that I would think about in that regards.
That's a great way of finishing this conversation. Francois, it's been amazing to have you on board. Thank you so much for the time. For those of you, again, that are not following Francois on socials, please do, because he's sharing incredibly insightful posts. And Francois, best of luck for this new stage of your career, for teaching. I hope you get many, many more students with your new venture. And I look forward to continue the conversation with you this year. Thank you for coming to The Blunt Dollar.
Thank you, Ignacio. Thanks for having me.
The Blunt Dollar is written, produced, hosted, and edited by me, Ignacio Ramirez. Everything you hear, concept, script, sound design, and production, comes straight from my desk, and occasionally my kitchen table. Thank you so much for listening, and join me in the next episode of The Blunt Dollar for more raw, honest finance conversations.